part of the portfolio models you did, we have to look at corporate parenting. Now, when we talk about corporate parenting, what is corporate parenting? Corporate parenting refers to the relationship between the head office of an organization and its various strategic business units. It could also include what? The relationship between the parent and his subsidiary, right? So in particular, it considers how the parent company adds value to its strategic business units. So as I told you, corporate parenting is a key theme in your exam this night, right? So how does the parent add value to a strategic business unit? So the extent to which parent company staff become involved in the business strategy development process will differ between what organizations, and the degree of involvement by the parent company will have what? A significant impact on the role of central departments, okay? So the whole thing about adding value is about mostly about what? Centralization and decentralization, and how these ones can help what? Create value or destroy value in a particular or strategic business unit. So what is the significant role of HR, of finance, of R&D in these departments, right? So there are various ways that the parent company, are you getting it, does this, or there are different styles they take. We call them parenting styles. So you may go to the exam and they'll ask you what are the broad parenting or corporate parenting styles that we have. And sometimes ICA will be tricky. They will just tell you that according to Gould and Campbell in 1991, they have suggested some broad parenting styles that are used to govern subsidiaries, right? What are they? Okay, so you must know the names as well. So by Gould and Campbell, write it down. So you say corporate parenting what? Styles. Then you put the what? By what? Gould and Campbell. I hope that's okay. Have you written it down?
Yes, sir.
So there are three types of broad parenting styles. We have what we call financial control. Okay. We have what we call strategic planning. And we have what we call strategic control. Please don't forget this. Financial control, strategic control, and strategic planning. Okay. Okay. So when we talk about financial control, how does it work? So here, the parent will act on behalf of its shareholders to identify and acquire assets and businesses. And it sets performance standards. So this is what you need to remember, okay? So for me, you know, I always highlight things that you need. So the parent will set performance standards for the SBU for the purposes of control, right? And then it will monitor and evaluate their financial performance. So I set targets, I monitor you, right? However, the managers are given autonomy for carrying out their business activities and decision-making at their own level. So here, delegation is done. You do your own thing, right? But I'll tell you, okay, for ROCE, I want you to achieve ROCE of 30% for me. Do you get it? So I set financial targets for you, but you're on your own. You're autonomous, right? Do what you want to do. So it's like a parent leaving a child to live his own life on campus. But you must always make sure that the money that I give to you, use it in this particular way. When you are vacating, I'll come and check whether you use the money in the particular way I told you to. So live your life. I'm not going to control you. I'm not going to tell you where to go for break, when to come home, right? But the money I've given to you, make sure you account for it in this way. Make sure you do not spend more than this. Make sure you do not spend more than that. Do you get the parenting style? You see, some parents are like that. They are not going to interfere so much in your life, but they make sure that whatever you need to do, you do it. Is it understood?
Yes, sir.
So yeah, it's more about financial control, setting financial targets to evaluate your performance, right? So remember, I set targets for you. I leave you to be on your own, but I check your performance against those targets, right? Okay. Now, that is what we call financial control. The word is financial, setting financial targets. Use it to remember, right? Okay. Now, let's go to strategic planning. So with strategic planning, the corporate parent aims to what? Enhance the synergies across the various business units, coordination, right? To enhance coordination and synergy across the various business units. And this is where the parent will decide to provide a central service. I get resources to facilitate communication and cooperation between what? The various SBUs and establish a common purpose. So here, this is where the parent will what? Plan with you and for you. Okay, and make sure that, okay, I will centralize some services. Let's say I have a central R&D department, right? Which oversees all these divisions. Like if you all need R&D, you should come to the parent company, right? Or you should come to what? The head office. Do you understand? And he's doing this so that all of you can work together. Because when you have a central department, you will be pushed to work together and cooperate to get those central services. Are we okay? All for a common purpose to enhance goal congruence or to ensure that the business will overall get value. Do you understand?
Yes,
Very
sir.
well.
Okay. So assuming you were a parent, between these two ones, which one would you choose for your children to create value for them? Between these two.
Sir, I think I'll go for strategic planning.
Strategic planning. Okay, why?
The reason being that with them, the children, they have unique talent. And those unique talent that they have, what a little support is given to them, they can utilize upon it, of which the nuclear family has been set up, that everybody can put their resources together then to help them.
That's okay.
So by doing that, I will promote and ensure that certain parental control that I wish to guide them, I will support that, but without compromising their unique talents, how they should develop their talent in order.
Okay, that's fine. Okay, so let's look at strategic control. Who has seen this before? So there's this church here which has been created, right?
Hello, sir.
I can hear you, boss.
Yeah, please, I also consider financial control. The reason being that setting the financial performance for the various strategic business units will also help them to spend within certain limit, so that by the end we can get so much to pay our shareholders.
Okay.
Although they will have independent control, but with the anticipation of the financial target in mind, they will ensure that those targets are met, and also they will be measured through that target.
Okay, that's good. That's good. I hope you all understand this now. Now, the third parenting style is what we call strategic control. And this strategic control, most of you have seen it before. You see that sometimes churches will just put up a branch, right? And then the branch, though they have people there, they will send maybe a lead pastor from the main church to go and head that church. You've seen it before for some time. Are you getting it? Until things hold. Then, once things hold these people on their feet, then the pastor goes back to the original church. Who has seen it before?
Yes, is there? You have seen it before.
Is there, pa?
That is what we call strategic control. I hope I've made it practical enough for you. So here, the parent will deploy his own resources and competencies to the strategic business unit in order to build value. And his own capabilities are therefore used to seize opportunities and achieve growth. So that pastor will come with the experience and then the lessons. Are you getting it? And then the value he learned from the headquarters. And he will come and head that place and make sure things stabilize or the value is created. Then he can either stay there or leave back to the original headquarters. I hope that is okay. So how many broad parenting styles do we have to parent our subsidiaries or strategic business units?
We have 3.
3.
We have 3.
Okay. So financial control, simply we set targets, right? Financial targets and measure performance and check the performance, right? Then we have strategic planning where we centralize rules, are you getting it? And ensure communication and cooperation among the SBUs. Then we have strategic control where we deploy our own resources, are you getting it? In order to build value using our own competencies to seize opportunities and achieve growth in the SBU. I hope that is okay. Now we have been saying adding value. The parent will add value. The parent will add value. Now, what does adding value amount to? The primary role of a corporate parent is to manage the SBU within the organization. And the way they do this can impact the SBUs by either providing opportunities for the SBU and therefore creating value, or adding costs to the SBU and then so destroying value. So you can either be a good parent and add value to your child's life, or you can destroy value. I think the last time we met, I talked about this. Do you remember? Now, a parent company should aim to create value while taking care not to destroy the value that is added. And I told you, how do you create value? You provide opportunities, right? How do you destroy value? You add costs, right? You create more costs so that they become constrained, right? So what are some of the ways? This is a typical exam question where they are going to ask you this diet. Ways in which the corporate parent can provide value to the underlying entity, okay? And it's 5 marks. So how does a parent company provide value? One, provision of resources, like the parent can provide some financial investment or expertise, maybe a coaching expertise, right? Or some maybe financial expertise, maybe HR expertise. Is adding value to the organization. Does that make sense? Shall we proceed?
Yes, sir.
The parent can also provide central services like HR, information systems, finance, and so on. If provided at the organizational level, it will result in some cost savings and lead to economies of scale. The parent can also help monitor performance and take corrective actions as a way to create value within the organization. The parent can help share knowledge and expertise across the organization. The parent can help facilitate communication, cooperation, and collaboration between the SBUs and provide access to his suppliers, finance, markets, and other stuff that may be out of reach for that business unit. So all these things that the parent does end up creating value for the business unit or the subsidiary, right? I hope that is okay. I hope that is okay.
Yes, sir.
Okay. Now, in which way can the parent destroy value? He can intentionally add high administrative costs that you would have otherwise not incurred, right? The parent can apportion fixed overhead. He can create a lot of administrative overhead, and this will end up destroying value if this cost exceeds the benefit that the SBU receives, by being part of the group. So if this happens, this may reduce his return on investment and basically is what? Residual income and other profitable ratios, right? As a result of that, his value will keep drawing. You get a drop in bonuses, the manager there cannot get, it will demotivate the manager, right? So sometimes they do this to, send or close down some particular divisions, right? Just to take them out of the market, maybe probably because they just want to create the impression that they are not doing well, or they feel like that division should be taken off, right? It's the parent. You can either add value or destroy value. Now, we can have increased bureaucracy, which can slow down decision-making and hinder flexibility and responsiveness within that particular division. Okay, so sometimes this can also happen. Okay, and also the strategic direction of the company can become confused or difficult to understand if the organization as a whole becomes too complex. So sometimes look at the way the parent destroys value, add admin costs or increase costs, increase bureaucracy to make it difficult to take decisions, or make the group structure complex, right? Which makes it difficult to maneuver your way around the organization. These are all ways which the parent can destroy value just to take a strategic business of the business of the parent. Is that okay? So, in what ways can the parent create and destroy value? Yes? In what way can the parent create and destroy value? My question to you.
Okay.
Can the parent create and destroy value? Yeah.
Okay. The parents in this case can create value by way of supporting them with the financial resources that are needed, and also to provide central services that they needed, and also to support them with distribution channels. that need to advance in. But with the cost that or something that can destroy the value, it can be done through when they add more administration costs to the SBU. Secondly, when bureaucratic structures that make it to understand or to make the SBU to take their own decision. And thirdly, also they can also destroy value by let's say I think I forgot the last one.
Complex, making complex.
Increase bureaucracy too.
Yes, increase bureaucracy, make the group structure so complex, right? So after making structure complex, people might likely drop off because things are getting quite difficult to manage. I hope that's okay. Is everybody on point now? So let's look at why should we add value, or what is the rationale or the mindset behind the parent company either creating value or destroying value, right? So according to JSW, they identified 3 corporate rationales which a company can adopt in order to create what? Value. So remember PSP, okay? PSP. So the first is what? The first rationale is a portfolio manager. Maybe the rationale I'm taking is a portfolio manager. And these rationales also go together with the parenting style adopted, right? So the mindset behind you as a parent, that's the simple meaning. So what mindset do you have for your child as a parent? That is why you adopted that parenting style. Does that make sense? So I may have some mindset. That is why I decided to go with strategic control. I may have some mindset behind me. Are you getting it? Or I may have some particular mindset. That's why I went with financial control. I may have some mindset. That's why I went with strategic planning. I hope it's clear. So first of all, the first mindset or the first rationale is portfolio manager. Now, the aim of the portfolio manager is to identify underperforming businesses and then allocate resources in order to improve them. So with the portfolio manager, he thinks that, okay, there are many business portfolios, but what I'll do is that I'm going to acquire businesses which are not doing well, improve them, are you getting it? Are you getting it? And provide central services, put targets down for them to achieve, to become high-performing businesses, but you let them, retain their own autonomy within those parameters. So do you see this? I'm going to acquire businesses which are not doing well. Are you getting it? I'll give them resources, set targets for them, centralize services, and make them retain their own autonomy. So with this one, which parenting style goes with this rationale? Look at it carefully. Look at it carefully.
I want to try. I think it's strategic control.
Yes, this one
because with the strategy.
This one relates more to strategic control and a bit of strategic planning too is there, right? Because of the centralization of the services. Do you get it? But it's purely strategic control because you set targets for them to achieve, right? But the synergy manager, okay? So with the portfolio manager, the parent will parent a significant number of business units or subsidiaries, which may or may not be related, right? So the SBUs will come from a variety of industries, different industries, which may be related or unrelated. So definitely a conglomerate, right? So here mostly we are dealing with conglomerates. Okay. Now, a synergy manager seeks out SBUs where synergies can be achieved across the various strategic business units it manages. So let's say that you have SBU, which is a retail store, right? Which sells, let's say, food stuff, also. And you have another SBU which deals in packs, right? Food pack, okay? And you have another retail store which deals in maybe, or you have another that deals in juice bar. You see these ones, they are all related, right? Since all these businesses are related, you can sort of create synergies among them to create what? Something that can generate a lot of value. Do you all agree? Do you all agree? So here we try to achieve what? Synergy across what? The various SBUs that we manage. And it is a hands-on parenting style that the parent is likely to need to intervene most of the times to ensure that these synergies we are seeing, how these people can work together, right? So if you buy food stuff, the food packs are sold, or these people can transfer goods from here to here, and also, and these food packs, we can add juice to it in the juice bar, and then it goes to the final consumer. You see how synergies were created? Can you see? Leading to a whole value chain. Can you see?
Yes, sir.
So we are saying that here, you look at how you can create, you look at businesses that work well together and link them together, and often intervene to ensure that those linkages you created materialize in practice. I hope that makes sense to everyone. So what parenting style does this really relate to? This one relates more to strategic planning, right? You can see.
Very well.
Yes, because it's all about what? Creating synergy and coordination and linkage among the various departments or the various SBUs too. Okay, so that is it. Now, let's look at the last one, which is the parental development. So here, the parent will use its own skills and competencies to improve the performance of the SBU. The parent must have a clear understanding of the SBU's needs as well as of its own value-adding capabilities, so that it can be sure of being able to add value to all of its SBUs. Any SBU where the parent is unable to achieve this should be divested or sold. Which parenting style is here?
Strategic control.
Why strategic control?
Because here the parents deploys their own resources and competences.
Like the church, right?
Yes, like
So
the
you
church.
send the pastor there, his own resources to go and improve this one, right? When the pastor stabilizes it, then the pastor comes back to the original church. So strategic control. So what are the corporate rationales? What are the rationales for corporate parenting or rationales for adding value? I can decide to act as a synergy what? A synergy manager. And what does that mean? What does that mean? A synergy manager.
It means that the synergy manager means that to identify all the SBUs that they don't work on their own or to achieve their own objective, but they should collaborate and coordinate to work to achieve the goal of the organization as a whole.
Okay. Okay. And then what you do is that sometimes you need to intervene to materialize the synergies, right? Then what about a portfolio manager? A portfolio manager will what? Acquire businesses which are underperforming, also improve them, set targets for them, and measure performance, right? To ensure that those portfolios can enhance value or you can create value for them. Okay, and these portfolios that you are improving might not necessarily be in the same industry, right? They might span across different industries. Then a parental developer will use his own skills and competencies to improve the performance of a strategic business unit, right? So this one, the parent will understand the need of that SBU as well as how it can add value or create opportunities for it, right? So when the parent is not able to do that, then he can sell that SBU. Please don't forget these things. You say, hey, the guy said it too, it came. You. Yes, boss.
Yes, with a parental developer, let's assume that the company wants to expand, and by way of expanding, they've acquired various SBUs of which they are not related. For example, let's take one company that is producing cosmetics products. Now you acquire SBU that are producing leather, shoes, and all that. Since the parent company who has been in that cosmetic industry for so long acquired the skills and competency to compete well, but don't have the idea. Most of the idea in terms of strategies, planning, and other control systems, we manage those SBUs that they've acquired. So how would a parental developer achieve that? If they want to support, direct, provide for those SBUs under its umbrella.
Mostly a parental developer would work, okay? The rationale would work if only the parent is able to use its skills and competencies to improve the performance of the SBU. If he cannot do that, then that SBU must be divested because there's nothing you can do about that. Do you understand?
All right.
Because if
Thank
you
you.
try, you create more damage than good. Do you know there are some businesses like that? The more you try to help them, because they are not in your industry or you do not have the competencies to help them, you end up doing more damage than good. Is that okay? And this can be better understood by understanding the model, one of the likely models for this diet. One of the likely models for this diet, the ASHRATE portfolio display. Okay. Now this model, students don't like it at all. And it has never been examined in this ICA syllabus. Okay. But who knows? You just have to prepare. Is that okay? Is that okay?
Yes, sir.
Okay, now before we understand it, this is also a 2x2 matrix, just like the BCG and the portfolio models that I sent you to watch, right? But it is a tool for assessing the attractiveness of potential acquisition targets or existing businesses to the parent companies, to know which businesses we can add value to and which ones we should destroy value in or we shouldn't acquire. Are we okay? As a corporate parent, this is the most important portfolio model that every student is supposed to look at and know, right? This model is very important. Now, we use it to assess the attractiveness of what companies we want to acquire. So maybe you may be looking at mergers and acquisition. They tell, oh, there's a potential target, and this is the field, and this is the benefits. Okay, the field is the same as the fit. So this is the fit, and this is the benefit. Okay, so when we say fit and then benefit, what does it mean? Or field and benefit. When we say benefits, it refers to the value that you can add to that business. Okay, so not all resources and competencies of the business will be relevant. Only those required for growth to be included, like the areas in which you can help them. So if you can add opportunity to that business or you can help them, right? The more a business can help the SBU, the more value it can add. So if you cannot help it or you do not have ways to create opportunities for that company or for that business unit, you cannot help it, right? When we talk about field is a strategic fit between that business and you, the parent, right? So it considers your similarities, like your industry, similar organizational culture, structure, and so on, right? Your staff structure is the same. Okay, so in simple terms, the field must be like you guys operate in the same industry, right? In simple terms. And benefit is whether you can add value to it. Now, these two things must work, and they must work well, right? So before we go, let's create an example before we understand this, right? So there's this guy looking for a wife, okay? So this is Kofi, and Kofi is a chartered accountant, right? A professional accountant. Kofi is looking for a wife. So let's take A. So he has 4 options. A is Araba, right? And Araba is a nurse. Araba is a nurse, okay? Let me see. Very caring. And what is Kofi looking for? Kofi is looking for someone who is caring, loving, and appreciative. Okay? So Alava is caring, loving, and also appreciative. Okay. But Araba is a nurse. Let's go to B. We have Brittany. Okay. B is Brittany. And Brittany is let's see. Somebody should give me an unrelated profession. Okay, she's not working.
Teacher.
She's not working. She's not supportive. She's arrogant, but she's loving. Okay, so let's just say this is all we have. Then we have C, we have Comfort. Okay, now Comfort is a cashier. Okay, she's not a people person. Not a people person, right? She's not a people person, but appreciative of what anybody would do for her. Okay. Then we have D. We have Diane, who is an auditor. Okay. She's an auditor. She's caring, loving, appreciative, and she has a high net worth. So now, if you are matching Kofi against all these matches, right? First of all, we must know what Kofi has or the kind of person Kofi is and what Kofi is looking for. So Kofi is here is a corporate parent. I hope that makes sense. So first of all, we are looking for businesses that will meet our fits or what we call our field, meaning we are in the same industry or we have what similarities, right? In structure and culture. Are we okay? Then we look at the benefits, whether it is something that we can add value to. So let's look at all the ladies we have there. Which one would the fit? Let's look at the fit or the field, right? So when we look at the fit, that means our CSFs and KPIs, can we apply it to that business? I get it. So where the fit is high, meaning that, oh, we are in the same industry or we have similarities in culture and structure, and then we can also add a lot of value to that business. That business is what we must invest in. We call that a heartland business. If you nipa no nini or so. So which of the ladies do you consider heartland? Which ladies will have a high feel and a high benefit?
The auditor.
Diana.
Diane, right?
Yeah, Diane will be appropriate.
Why? Because when it comes to the field, she's an auditor, right? Same structure, same industry, right? When it comes to the benefit, whether he can add value, yes, that's what he's looking for. He can add value to caring, loving, and appreciating, right? So the field is high here. The benefit is also high here. Do you understand? So because it's high, we consider Diane to be the best match, right? Because the best match in that he meets the competencies of Kofi, and she also meets what? The value that Kofi can add to her life. Do you understand? So this is a business that Kofi should go into, or this is the woman that Kofi should marry, because this woman will tend to understand Kofi better, and Kofi can add value, and already she's a high net worth person, meaning that she can add more value too. I hope you are starting to get the model. Does it make sense?
Hello, sir.
Yes.
Yes, boss.
Yes. One thing I observe is that, Diana is an auditor. And to become an auditor, you have to belong to a professional body. For instance, I might assume that Diana is a certain accountant.
Of course, she
So
is.
they are the same industry.
Yeah, that's why I said the field is high.
Good. And what about the benefit? The benefit will be high if Diana lacks certain competency.
In this case, I'm just using this as the benefit, the loving, caring, and appreciation. For now, we are not taking, that's the only thing I used. So we are just
okay. All right. Thank you.
Okay. But I hope you all get it now.
Yeah.
So that is what we are using now. clear. Now we understand what a heartland business is, right? So with a heartland business, these businesses operate in the same industry and the field is high. The SBU may lack the competencies it needs for success, and the business has the relevant skills. So the opportunity to add value is high. Do you get it? I think that's what Bright was trying to say, right? So the parent will be able to add value to the SBU without harming its existing business. We will not harm her because already we are looking for what she has and we can improve it. Do you understand? Okay. Now let's go to a business that has what? A high feel. Okay. So the feel is high. Do you get it? The feel is high. I get it. But then the benefit is low. Do you understand? So if the benefit is low, but the feel is high, we may be in the same industry, but we cannot add value. Do you understand? So which of them will relate to this one? Which of them is likely to relate to this one?
Is it comfort?
And how will you explain it? Why are you saying, how will you explain that one?
I'm thinking that because comfort is a cashier, they are, and Kofi is an accountant, so they are in the same industry. But then when it comes to the benefits, she's not a people person, and she's also not appreciative. So
you could
value can be added.
the benefit is low, but the fit or the feel is high, right?
Yes.
So that would be a ballast business. No, so
Yes.
okay. I hope you guys are starting to get it now. I hope you are starting to get it now.
Yes.
Okay. So let's look at the businesses whose feel is low, meaning we are not in the same industry, and we cannot also add any benefit to them, right? They are called alien businesses. These businesses, you divest from them. So let's look at it. Which one of them is alien, completely alien?
I think B, because not working, not supportive or arrogant.
Okay. That is it. You get it. So that's an alien business. But you must be careful. Some alien businesses may trap you. Though she's not supportive and she's arrogant, she's also loving. So this could also mistakenly show you that, oh, this person is not that bad, but at the end of the day, it can create a liability for you. Do you understand? Now let's look at one which will trap you. Who is a value trap business here?
Araba.
Araba. Right? You can add a lot of benefit because she meets all your boxes, right? She ticks all your boxes. She's caring, she's loving, she's appreciative. But adding value, are you getting it? Or the feel is low because she's a nurse. She's coming from a different industry. So when she's going to shift, you're also coming late. There may be a problem, right? Because you guys do not often meet. By the time you come home, she's tired. By the time she comes home, you're also tired. So it is going to create a value trap business, right? I hope the example I used made perfect sense. You understand the
Yes.
model now? Yes, there's a model students don't understand. That's why I made it that way so that it becomes easier for you. I hope now we understand the various businesses. So now let's read a little about it. I want you to draw this in your book quickly. Okay, always when you get portfolio models, remember to draw them and fit the names there, just like how I taught you the stakeholder. So ballast, who was ballast? For our example, who was ballast?
Comfort.
Comfort.
Diane was ballast.
I was
Oh,
Diane.
comfort.
No.
Diane, comfort.
Diana was
Comfort. Comfort.
Diane was Heartland.
Yeah.
Alien was
Heartland.
Brittany. And
Brittany.
Value Trap was Araba. No, so A, B, C, D. I hope we won't forget. So in simple terms, high feel, high benefits. It's what business? Heartland, right?
Yes.
Okay. High feel, low benefits will be what type of business?
Ballast.
Ballast. Low feel, high benefits will be what kind of business? Value trap.
That is value trap.
Low feel, low benefits will be what?
Alien.
Alien. Okay. So now just write this in your book and draw the diagram. We are going to learn the various strategies for creating value or destroying values in these particular businesses. I hope this model is not confusing.
The moment we are writing.
Sure. I did for you.
Okay.
So, sir, I want to get this. I want to get this one clear. So, with this, if the parent company and the SBUs are in the same industry, that means the field is high, right?
Yes, the field is high.
So, and if the SBU is unrelated, that means they are outside the
Yeah.
industry of parents. So that means the field is low, right?
Field is low, yeah.
And if the SBUs lack certain competency and the skills to be successful in their operation, and they need the support and the skills from parent to help them achieve that. So that means the benefit is high, right?
It's high, yeah.
And if the SBUs doesn't need the support of the parent because they are already successful by using their own skills and competency, so that means the benefit is low.
Yes.
Right. Good. Okay. Thank you very much. That's just to clear my mind on that.
Sure.
So that I can.
This one that you are using us to learn.
Yes, sir.
This one they are using us to learn.
Oh yes. You know that's how we learn. You know, so that when we get to the exam hall, they can use that base to analyze the case. So that'll be fast.
Good.
But I hope everybody is okay now.
Yes, sir.
Okay. So let's see. Let's look at Heartland businesses. So,
Sir,
yes, please.
can you also use an industry to explain this instead of using an accountant and then?
Oh yes, I'll come and take a better one. Don't worry. I'll come and take a better one. I'm coming. Let me open.
Okay. Thank you.
I wanted you guys to get the understanding in a layman's terms first, right? Otherwise, when I move straight to taking a question, it might be a little confusing. I hope that's okay.
Okay.
Yeah, so don't worry. I'll use a better industry for you. Strategic portfolio. Yeah. Look at the question before you. Please, let's read. Who will read for us?
Illiteracy 1, right?
Yeah.
Okay, I'm reading.
Okay, sure.
Bazaar stores is a food retail business that wants to pursue diversification strategy. Bazaar want to diversify as follows: trending hotels, commercial property development, a depressed market at present, chain of clothing stores, supermarkets. The main skills of Bazaar lie in identifying consumer trends regarding food and selling food and related supplies to meet these needs. Required. Using the above information, label the business using the asterisk portfolio display and access the significant to Bazaar's skills. Yes, Bazaar skills. 10 marks. How can Bazaar create or destroy value for 8 businesses units? C. What approach to corporate parenting are available to Bazaar if it acquires the supermarket?
So my question is, Bazaar is into food retail business, right? Since you said you wanted to be in an industry, he's in food retail business, and then he wants to go into these ones. So we are looking at fits or feel, and then what?
And
the benefit.
And benefit. So let's look at which one. You are into food retail. You decided to go into trendy hotels. How is the fit and how is the feel? Because they said Bazaar's main skills lie in identifying consumer trends regarding food and selling food and related supplies to meet those needs. So these are like the CSFs and what? Competencies of what? Bazaar, right?
Yes, please.
So which one up there do you think Bazaar's CSFs and competencies can help?
So I think the supermarket will be a heartland because they are in the same industry.
Supermarket, eh? Do you all agree?
Yes,
Supermarket
please.
is heartland. What
Yes,
about
sir.
chain of clothing stores?
So the chain of clothing stores will be a ballast. Reason being that, no, it will not be the ballast. It will be value trap. Value trap because they are not in the same industry.
But
because they are in the same industry.
But
But if they need certain support skills from the bazaar, they can improve. That's where it will classify as the value trap.
Yes, because even though we are not in we are in food retail business, right? Because of retail, it can support clothing. What do you agree? Though we are not in the same industry, we have CSFs and competencies that can assist in retail, because a chain of clothing stores is still retail, right? Though the retail I'm coming from is food, I can still apply the same knowledge to retail of clothes. True or false?
True.
Yeah, so this is value trap anyway, because you're not in the same industry, but the benefit is high, right? Do you all agree?
Yes.
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 Okay. What about trendy hotels? Chain of clothing stores should have been ballasted. Not ballast.
No, sir, if ballast, are they in the same industry?
No, they are not in the Bolivar is clothing and you're talking about food retail. But then the
So if they are not in the same industry, the feel is not going to be high. The feel is high when they're in the same industry. So the chain of clothing stores is not food. It's not food trend or food selling, whatever it is. It's clothing industry, food industry. So the chain of clothing stores, if ballast, that means they are the same industry. That the feel is high. But with the ballast here, the feel is high if they're in the same industry. And if they have their own competency to achieve success, therefore the benefit will be low. So, but if they lack certain skills or certain competency, and there's a need for the parent to support them to achieve success, so that means it's going to be ballast. That means the benefit is going to be low. High.
Yeah.
High. So in this scenario, the major aspect is that are they in the same industry?
No,
if chain of clothing stores are not in the same industry, then balance will not be.
So it's value
there.
trap.
Yes.
Value trap.
So it will be
What about trendy
value trap.
hotels?
Yeah, trendy hotels. The issue here is that trendy hotels is going to be how do you call it?
Alien.
Alien.
No, alien
Yes,
will be commercial property development. Hotels and food are
yes, alien. As for alien,
Yeah, but the benefit.
property.
So the benefit will be
the benefit will be low.
The benefit
will be
low, but the field is high.
It's high, yes.
Because hotels and food are related. Or
Yes, please. Yes.
Aspects of hotel deals with hospitality, food. Yes, so I think the benefit here is what will be low because of how but the field, the same industry.
The field is high. Yeah.
So this one would rather be balanced, right? It depends. It's not always true. It depends on what other points you add, right? But I hope we are all getting it.
Hey, can I come in?
Sure, you can.
This? You know, for the hotel, I will consider value trap. The reason being that that's the hospitality industry, because the feel is low because they're in the same industry. But so far as if you're in the hotel industry, you have hotel trend, for example, and you acquire a hotel as you being in the food supply industry, you can also operate a restaurant in the hotel. So therefore, if the hotel need those skills to be additional value for the hotel to progress, the customers may want to eat, some want to get their food, whatever it is. Then you can support them with that idea because you have that skill already. So with that, I choose for value trap for a hotel, the trendy hotels.
Okay.
Yeah, can I come in, sir?
Yes, boss.
Yeah, I think the balance will be the Trend Hotel. Why am I saying that? You see, the hotel industry, any hotel that you have definitely have to serve people when they come to the hotel. So the retail industry basically have all the food that you need to serve over there. So if you are saying that the fee is low, the fee is definitely high, but because it's a hotel industry, but it's a service industry, and the retail industry of the food have a link with them. You are looking at the entire related, not that the food in the hotel industry just out of the food industry, but they have a related something here. So the fee definitely will be high, but really the benefit that will come from it will be definitely low. So that one still, when you go to the chart, it will be the what do you call it, the balanced business from the 4 over here.
Okay, I like the way you guys are thinking. Everybody is having a point. Next up,
Sir,
you just have to comment. Yes, boss, I'm listening.
can I clarify?
Sure.
You see, we talk about field. The question is that there are so many industries that we have here. Hotel industry is different from retail food industry. It's trade center, but hospitality, the hotel trending is like service rendered. But this one do it open. So the industry aspect, as the learned colleague said, that the field is high. I think the field should be low because they are a separate industry. But the reason why I say that the value trap is because every industry or every hotel or whatever it is, they need food, they need stores. So that can be added to that. So if Bazaar acquired the hotel, any hotel, it can support the hotel with those things for them to what? To get success. So in that case, the benefit benefit is high.
The benefits,
but that can be classified as value trap.
Okay.
Yeah, the benefit is high, but the field is. How we are okay.
Yeah, I understand. I understand. You all have a point. It depends on how you explain it. We want to see whether you really understand the model. So let's see. When you want to start, you talk about the nature of the business, right? Then this is it. So I chose supermarkets as being either heartland or ballast, as it is debatable whether further opportunities exist for value to be added, right? So your supermarkets, it's not all supermarkets that go directly into food, right? If it is, we can still create value for them. Do you understand? Making them ballast in that aspect. But if it relates to food, then you can talk about it as being heartland, right? Then chain of clothing stores or selling jeans, it is alien. But it could be, there's one aspect we call edge of heartland, meaning that yes, the skills can be transferred to identify trends in clothing as well, right? But most of the time, ICA likes to stick to heartland. So you could say that clothing stores may be alien. Sometimes you could even classify it as value trap. It depends on how you are looking at it. You understand? That's why I said these models are not definite. It depends on the explanation that you add to them. Do you understand? Do you get it?
Yes, sir.
So as you said, the hotel, here I chose value trap, you can see. Because the head office may believe that it has the skills to add value to food side, but in reality, CSFs are more concerned with marketing, staffing, and cost control. So as you were saying, but if you consider it balanced, then you can look at the food side as being what? One side that is, the structure is related to yours, but in terms of value, the value or opportunities to add value may also be low. It depends on how you explain it, right? You just have to have a good and solid word argument, right? Then property development, we said it's in a current depressed market. That means that nothing is going on in that market. Are we okay? Now,
Yes,
as
sir.
with using the BCG, you already know about the BCG. It will be important in the examination that your answer is not laid out as we see above. You will need to provide more relevance and depth. You should have a separate evaluation for each business unit that follows these steps, right? suggest how the business unit will be classified under the parenting matrix, and evaluate whether the suggested strategy from the parenting matrix will be appropriate in this scenario. That's how we answer the question, right? So you talk about each of them, then you draw. I told you to always draw the diagram, right? It will fetch you marks. Now, the B part said, how can Bazaar create or destroy value for the business unit? 10 marks, yes? So I said, yeah. Now, questions are more answer. What are the answers to this? Yes? How can Bazaar create or destroy value for the business units?
Okay, the Bazaar can create value by providing central services to support the SBU, such as marketing, such as research and development, and accounting services, and the rest.
Is your only central services? It's 10 marks.
Okay, it can also add value by supporting them with the resources that they needed to achieve success.
Okay. What other way can they create value?
They can also create value by sharing of knowledge and expertise across the organization.
Sharing of knowledge.
Monitoring performance and taking corrective actions.
Okay.
And then facilitating communication and collaboration between the SBUs.
Yes, synergy, right?
Yeah, synergies.
And also help them in the setting of strategies and allocation of resources, right? And also provide coaching to them. These are all ways you can create value. I hope that is okay.
Yes, sir.
Now, what approaches to corporate parenting are available to Bazaar if it acquires the supermarket? What approaches can Bazaar decide to go with?
So they can decide to use either the Gold and Campbell broad parenting style or the Johnson and Stokes corporate rationales. Am I right?
Yes, but yes, you can answer it that way. But here it's more about okay, they said approaches to corporate parenting, so you are on point. Yes.
Okay.
So here is the corporate parenting styles. So they can decide to go with strategic control, not so. And what does strategic control mean?
With the strategic control, the parents deploy their own resources and competences to the SBUs in order to build value. And then it's like they will withdraw after they build the value. They will leave the SBUs to be able to function on their own.
And then what about strategic planning?
So is the strategic planning involve that the parent to enhance synergy across the SBUs by provision of central services such as resources, facilitating communication and cooperation between them. That is for the strategic planning.
That's true. Then what about financial control? Financial control.
Okay, the financial control consists of the parent company or Bazaar identify certain key aspects by supporting them with financial to acquire assets and also to set financial performance targets for the SBUs. So the managers also of the SBUs will be given autonomy to carry out those activities.
Yeah, we set financial targets and let them achieve it, right? Measure their performance by making them autonomous, right? This is where you see things like ROI, RI, EVA, right, for divisional performance. So I think that was it for corporate parenting. I hope it wasn't bad. You see, it's not difficult, right?
We hope it will come.
Oh, it's a scam. It's not that we hope it will come. It is coming. It is coming, Ankasa. It's not that we hope it is. It is coming. You just have to know, right? That's all. That's all I need from you. Okay, so now I think for portfolio strategies, you guys are okay, right? You guys are okay with portfolio strategies. Any question around portfolio strategies?
We are okay.
Okay. Now, before you even do portfolio strategies, right? There's something we call the PIMS analysis, okay? And this PIMS analysis is an analysis that was done by McKinsey and the General Electric in the US, okay? And it was a database now maintained by the Strategic Planning Institute. So you may go to the exam and they may ask you about PIMS analysis. PIMS analysis stands for the Profit Impact of Marketing Strategy Analysis. So your marketing strategy, I get it, which involves you putting up SBUs to achieve competitive advantage or putting their marketing strategy. How does it have a profit impact? Now, the PIMS database contains data provided by several thousand strategic business units of major corporations. And the data consists of details about the activities and performance of the SBUs. And the database can be used to analyze factors that appear to make some strategies more successful than others. So the database can be used, for example, to relate the success of an SBU to factors such as its market share, diversification strategy, investment intensity, product or service quality, or labor productivity. Now, this database appears to show a link between profitability and your relative market share, right? Profitability and what? So in case you have to explain PIMS, you see, though I talk about so many things, you see, I only get to a place and I highlight. That means that is where the importance is. Do you understand? So if they ask you about PIMS analysis, you tell them that it was a database established by the General Electric, now managed by the Strategic Planning Institute, right? The database contained data provided by several different strategic business units. Are you getting it? And it appears to show a link between profitability and relative market share. So how is market share and profitability related? The higher the market share, the higher the return on investment will be. True or false? True or false?
True.
That's
So
true.
the connection between market share and investment return or profitability is probably due to economies of scale for a large firm in its market, arising perhaps because of the following factors. So these are the following factors that would increase profitability when you look at what? The impact of your market share, right? So profit impact of your marketing strategy. Now, the purchasing benefits of a large buyer. So if you're a large buyer, the benefit you get because of that economies of scale, right? The ability to obtain better terms from suppliers, like bulk purchase discount, may be a reason why you may have a high profitability, right? Because you get a lot of discount. Two, the advantage of selling in large volumes. So in an industry where profit margins are low, it is vital to have the ability to sell in large quantities in order to make a reasonable size profit. And the scale of advertising. You know, large firms can obtain greater benefit from advertising, for example, by advertising nationally. And you may have things like more efficient use of equipment and other non-current assets. And for retailing firms, the advantages of a large market share also include what? Easier access to new products from your suppliers, easy access to retail property. For example, large retail firms are more likely than smaller firms to obtain valuable out-of-town retail space in a new shopping center because they are large and they have the resources, right? So the PIMS analysis would therefore suggest that an appropriate product market strategy should be to seek a large share of the chosen market or the market segment, right? And this will end up what? Creating competitive what? Advantage, or will increase your return on what? Investment, right? So what, apart from the profit impact of your marketing, what other things did the PIMS analysis find? The PIMS analysis has also produced several other conclusions which appear to have remained consistent over time, that the relative quality of your product or service is an important factor for determining high investment returns. True or false? Is quality a factor that leads to profitability?
Yes, sir.
So that's what the PIMS analysis found as well, that relative quality means value for money for the customer. Although high market share reduces cost and so improve profitability, the benefits of high market share can be lost due to relative poor quality. True or false? That the less quality your product is, the more you lose profitability. High investment in capital equipment seems to reduce profitability as well, right? The more investment in PPE you make, remember, more maintenance costs will also pop up, right? crop up, reducing your profitability. This is often a characteristic of an industry as a whole, but you can also apply to individual companies within what? An industry. The most successful companies get better asset utilization, means more sales per CD of invested capital, right? It means that even if I buy more assets, I have what? Good maintenance, right? I have the resources to get more sales per CD of capital investment, right? So also acquisition strategies are not successful at increasing return on investment for shareholders because it will increase the asset base, reducing the return on investment. The main beneficiaries of acquisitions are usually the shareholders in the acquired company, right? Diversification is not particularly successful strategy in terms of return on investment because sometimes when you diversify, it can reduce your return on investment because it may take time for you to adapt to that industry. True or false?
Very true.
So this is what the PIMS analysis said. Maybe you may be expecting corporate parents, you go and then they decide to take something from portfolio, and this time they decided not to bring any model at all. They just decided to ask you about PIMS analysis. Then you see how many students will be thrown off course. But I hope it's not anything difficult. You can just use your mind to write something, right?
Very well.
Okay. So everything was about, okay, we saw 4 things. Let me break it down. We saw 4 things. What were they? 1, market share. 2, profitability or return on investment. 3, quality, right? Quality. And 4, capital investment, right? How do all these things relate? We know when quality is low, profitability will be low, right? Market share high, profitability high. Huge capital investment, if you are not a large company, can lead to lower profitability, right?
Yes, sir.
Diversification may not necessarily lead to what? High return on investment or profitability. Now, there's another model which ICA can just go and pick up. You see, I'm just giving you models. Have you noticed? Or you haven't noticed that it's models upon models that I'm taking? You see every model I highlight for you. So here you are looking at Hamel and Prahalad. Hamel and Prahalad. Hamel and Prahalad. Hamel and Prahalad. So we are looking at a product-based strategy and a resource-based strategy for your selection of the product and market that you want to operate in. Okay, so as part of your portfolios, you know, even your strategic business units must what? Come with a product and go to a specific market. So there are 2 approaches to select product market strategies for your SBUs. You can use what we call a product-based strategy, or you can use what we call what? A resource-based strategy. And these product-based and resource-based strategies are suggested by who and who?
Hamel and Prahalad.
Okay, please don't forget this. I know by the time it reads, I'm not pressure not so I'm with you, but write it down. That's why every model I tell you to write it down. So ICA, this question has come before. No student could answer. They all gave wrong answers. Pestle, 5 forces, answer. No. This is it. We have 2 main ways of selecting a product market strategy. 1, product-based strategy. What does it mean? So you should identify the product that you want to sell and the market or market segments in which you will sell them, right? The focus of attention is on which products are likely to be the most successful in their market and so the most profitable. Which one has the larger share of your market? And that becomes the most profitable. Now, Hamel and Prahalad suggested that instead of a product-based strategy approach, entities should use a resource-based approach. And instead of looking for competencies in it, instead of looking for the most profitable product, an entity looks instead at the strengths and competencies in its internal resources, as it believes that those will create more successful products, right? For instance, if I know that I want to create a good diversified product, right? I can start by acquiring quality raw materials, right? Which will affect my inbound logistics. Do you agree? And then if I have efficient production capacity, right, to avoid wastage and those things, I have good packaging mechanism, outbound logistics, and good sales. It can lead to a well-diversified or well-diversified product, right? Not so? And a good differentiated product, not so, which can also what? Create competitive advantage for me. So resource-based strategy is saying that, okay, you do not necessarily need product-based strategies to create what? To create profitable products. You can also use what? You look at what the competencies and resources you have to enable you to choose a particular product or market in a particular way, right? So by choosing products and markets in this way, the entity should have a competitive advantage over its competitors. So they argued that, Hamel and Prahalad argued that a resource-based approach to strategy selection provides a basis for deciding which new product areas to enter, product or market areas to enter, and which is what? More flexible. So a more flexible approach to strategic planning than the selection of target products and market as part of a formal long-term business plan. So this one, they are saying that don't select as a formal way, but just look at your resources and core competencies and see how it can create what? A magic product for you.